Imagine waking up tomorrow morning. You open your banking app, and for some reason, you can't access your money. You try again. Nothing. You call the bank, and suddenly you realize something most people never think about. The money in your bank account isn't just sitting there waiting for you. Banks use deposits as part of a much larger financial system. They lend money, they invest, they manage billions of dollars, and they depend on millions of customers keeping their money inside the system. But here's the part that matters. Does that mean your money is actually at risk? Not necessarily. In the United States, FDIC insurance generally protects eligible deposits up to $250,000 per depositor per insured bank per ownership category. But that doesn't mean every dollar you have is automatically protected. And it definitely doesn't mean your money is protected from inflation, bank failures above insurance limits, fraud, or poor financial decisions. So today, we're going to look behind the walls of the banking system and answer one simple question. How safe is your money really?
For most Americans, the bank is the safest place to keep money. Your paycheck arrives there, your rent comes out of it, your credit card is connected to it. Your savings are sitting there. So naturally, you assume, if I can see the balance on my phone, my money must be completely safe. But banking doesn't work quite that simply. To understand why, we first need to understand what happens after you deposit your money. Let's say you deposit $10,000 into a bank. You might imagine your exact $10,000 being placed somewhere in a vault with your name on it. But that's not how modern banking works. Your deposit becomes part of the bank's overall funding base. The bank can use funds to support loans and other activities. Your money could help finance someone's mortgage, a business loan, an auto loan, or a credit line. And in return, the bank earns interest and fees from its financial activities. This is one of the fundamental ways banks make money. You deposit, the bank puts capital to work, borrowers pay interest, and the bank earns revenue. That's why a bank isn't simply a giant storage facility for cash. It's a financial business. And that distinction is incredibly important. Let's get to the scary part. What happens if a bank actually fails? This has happened before, and when it does, customers can panic. They may rush to withdraw their money, and if enough people try to withdraw money at the same time, the situation can become extremely serious. This is known as a bank run. But here's where the American banking system has an important safety net. The Federal Deposit Insurance Corporation, or FDIC, generally insures eligible deposits up to $250,000 per depositor, per insured bank, per ownership category. That can include things like checking accounts, savings accounts, money market deposit accounts, and certificates of deposit. So if an insured bank fails, eligible deposits within the insurance limits are generally protected. That means the average depositor isn't simply left with nothing if their bank collapses. But there's an important catch. Let's say someone has $100,000 in an eligible deposit account at an FDIC-insured bank. Generally, that's within the standard insurance limit. But imagine someone has $400,000 in one ownership category at the same bank. Now the situation is different. The standard FDIC insurance limit doesn't simply become $400,000 because that's the amount in the account. The insurance limit matters. And that's why people with large cash balances need to understand how deposit insurance works. There can also be different ownership categories, which can affect coverage. The important lesson isn't banks are unsafe. The lesson is understand what is actually protected. Because financial safety isn't about fear, it's about knowing the rules. But here's something even more interesting. Your money can be completely safe from a bank failure, and you can still lose purchasing power. How? Inflation. Imagine you have $10,000 in cash. You check your account 1 year later. You still have roughly $10,000, plus whatever interest you earned. It looks safe. But what if prices increased significantly during that same period? Your account balance might barely change, while the amount of goods and services that money can buy has fallen. That's the difference between having money
and having purchasing power. Your bank balance can stay stable while the real value of that money changes. And that's something deposit insurance doesn't protect you from. FDIC insurance protects eligible deposits against covered bank failure. It does not guarantee that your money will maintain its purchasing power.
This leads to another common mistake. People sometimes treat their checking or savings account like a long-term investment. But that's not necessarily what it's designed for. A checking account is mainly about liquidity. You need money available for everyday expenses. A savings account can be useful for emergency funds and short-term goals. But long-term wealth building is a different question. Stocks, bonds, retirement accounts, businesses, real estate. Different assets carry different risks and potential returns. The point isn't that you should move all your money out of the bank. That's a terrible conclusion. The point is that different money has different jobs. Your emergency fund has one job. Your retirement money has another. Your everyday spending money has another. And treating all of them exactly the same can be a mistake.
The biggest danger isn't necessarily that your bank will suddenly disappear. For most people, the bigger danger is false confidence. You see a number on your screen. Maybe it's $20,000. Maybe it's $50,000. Maybe it's $100,000. And you think, I'm financially safe. But that number doesn't tell the entire story. How much debt do you have? How much interest are you earning? How quickly are your expenses rising? How much of your money is actually insured? And how much are you keeping in cash for no particular reason? Financial security isn't just about having a large bank balance. It's about understanding what that money is doing. So, what should you actually do? First, understand whether your bank is FDIC insured. Second, understand the standard $250,000 insurance limit and how ownership categories affect coverage. Third, keep enough liquid cash for emergencies and near-term expenses. Fourth, don't confuse a bank balance with long-term wealth. And finally, learn how inflation, investing, debt, and risk actually work. Because the goal isn't to be afraid of banks. The goal is to stop blindly trusting any financial system you don't understand. Your money doesn't have to be hidden under a mattress to be safe, and banks aren't automatically dangerous. But financial security begins with one simple habit. Know where your money is, what protects it, and what it's actually doing. Because the most dangerous thing in finance isn't always losing money. Sometimes it's believing you're completely safe when you don't understand the system at all. Subscribe for more videos breaking down the hidden rules of money, banking, debt, and the American financial system.